Welcome back, listeners. My name is Larry Kallevig, founder and CEO of the Haven Financial Group. And if you're just tuning in, you're listening to the Haven Financial Group radio show, where we discuss crucial retirement and financial topics that can really make the difference between surviving retirement and thriving through those golden years, which I hope they are. So if you're looking for more information on any of these retirement topics, about any key retirement topics or all those puzzle pieces, and by the way, do you have all the retirement puzzle pieces? Do they go to the same puzzle? Making these good decisions can really transform your financial future. So I encourage you, you're taking the time to listen. Come on in and visit with us. It might be insightful. You might learn something. Imagine that. I've yet to find out anybody that knows it all, including me. So we can always learn. And again, we stress education because that's where we learn to make good educated decisions.
We're addressing some of the key financial factors of retirement and some of the questions that you may have. We've talked about 529s rather, and if you have money left over, and we've had a bit of a conversation about turbulent markets and how to protect your monies from those in retirement. We want to talk about the power of the Roth. And the Roth account, I know, is something that you feel strongly about, whether it's an IRA or an employee sponsored like a 401k, right, Larry?
Yes. And before I jump into the Roth, because we really do like it, there's probably only one other type of account we like better, and that's your HSA, your health savings account. Again, tax-free in, tax-free growth, tax-free out. So it's probably the only one. I say that because people underestimate healthcare expenses. So I just wanted to say that HSA, if you are taking advantage of it, great. If not, you should be maxing it out to the best of your ability. Now, the Roth, tax-free growth. Contributions doesn't reduce your taxable income in that given year, but it grows tax-free. That's why we tend to take a little more risk in the portfolio with Roth because it's usually the last thing people touch. The withdrawals are tax-free. There's no RMDs on Roths. Giving you more control of your retirement savings and potentially allowing for greater wealth transfer because you can take it a step further. We like Roths also for beneficial interests. If you're not planning on using the money and legacy is important to you, it transfers to your heirs tax-free. And I point this out because oftentimes your IRA pre-tax, which I'm sure most listeners have to some degree, and I'm not talking this applies to anybody, not those with big balances, little balances, but everybody in between. That pre-tax money, oftentimes, maybe your beneficiaries are your spouse and then the kids. If applicable, could be other things too, charities, et cetera. But oftentimes, the kids, when they inherit an IRA from mom and dad, they're in their peak earnings years themselves. And guess what? Those hard-earned dollars that you mom and dad or grandma and grandpa, you've put together, now that gets taxed heavily, and I bet you probably didn't intend for that to happen, but oftentimes it does. That's why Roths are tax-free to those beneficiaries if that is important to you.
Just all the more reason for people to certainly look into this and consider these Roths. Let's talk about some of the drawbacks. You've talked about some of the potential good, and certainly most of the good is associated with taxes. Let's talk about the drawbacks. Income limits, number one.
And I think it's always the pros and the cons. Give me the facts. Give me the pluses and the minuses. If you only give me the pluses, then I'm thinking somebody's leaving something out of the equation. The drawback is there's income limits. If you're listening and you're a high income earner, you're probably not able to put it into a Roth. However, that doesn't mean that we don't help people walk through a backdoor Roth. Not going to get into it. It may not give you the tax benefits, but you still get money into a Roth. It can be done. I always say where there's a will, there's a way, potentially. And again, that could start with a conversation. We do have clients that do that. No immediate tax deduction. So it has to make tax sense. If it doesn't make tax sense, then it's the wrong decision. Depending upon your age, maybe that means putting more into a Roth. If you're later in life, maybe not as much into a Roth. There's time restraints with the Roth. There's a 5-year rule. To withdraw earnings tax-free, you must have held the Roth IRA for at least 5 years and be of age 59 and a half or older. So that needs to figure into the timeline. Does it make sense? Does it not make sense? Every year we're looking at what tax bracket our clients, what tax bracket are they in? For a lot of retirees, maybe early retirement, they haven't turned on Social Security for whatever reason. They're delaying it for good reason. One of the reasons is tax planning. Just this last week, this couple came in and she's going to turn it on when she retires at 66. He's going to wait till 70 for a variety of reasons. They have longevity in the family. The higher income remains. Plus, it gives them this window of opportunity to convert a lot of their pre-tax IRA money to Roth. Because we have these low tax brackets for the next 3 years, I hope listeners are tax planning. They're filling up that 12% tax bracket in the form of an IRA to Roth conversion or an IRA distribution. So with everybody, fourth quarter specifically, it doesn't have to wait till then, we want to make sure we have a good idea of income. And before December 1st is our deadline, what do we need to convert or distribute to fill that up? So forward-thinking tax planning, having a partner that can have these educated conversations with you. You don't have to do it alone. You don't have to keep track of the tax code, which doesn't always make sense. In fact, oftentimes it doesn't make any sense. So who's your partner? Who's helping you? Does it make sense? Are you even having these discussions? Again, this week, because we're in tax season, I heard somebody say, first year they've used Lance as their CPA, Lance and Melissa here. They go, you know what? We just got sick of dropping off our tax stuff and never even talking to our tax person, which is what a lot of people are doing. In fact, a lot of listeners probably go, you know what? Larry just described us. We drop off and pick up and we don't even talk to them. I would say, especially planning for retirement, that's not adequate. That's not enough attention. I've said it before. Lance's favorite thing is his whiteboard, explaining things, planning throughout the year. And guess what? Yes, you can leave after preparing your taxes with a smile on your face because there was no negative surprises that you experience every other year that you've done your taxes. Can it be done that way? Oh, yes, it can. But it takes a tax plan.
So, Larry, let me ask you maybe just to sort of paint a scenario where a Roth IRA conversion is beneficial for someone. Just, so people maybe would get an idea of what would be if maybe they are someone like that.
If a Roth conversion makes sense, sure. Married, say you have a couple married filing jointly, and their income for the year is $50,000 because they haven't turned on additional income sources yet. Well, with the standard deduction, the big beautiful bill, and the things related to the tax laws that have changed, there's a big window of opportunity that potentially $60,000, $70,000, $80,000 could be converted from an IRA pre-tax to Roth. Yes, you got to pay the taxes, but let me ask a very simple question. Do you want to pay less taxes today on that money or more taxes on that money future? I think there's only one answer. So we want to fill that bracket up. And again, now you have more money in Roth. And what the big threat to folks when they get to required minimum distribution age, which for many listening, it's 73 now, not 70 and a half, 72, it's 73. And then about 6 years, it goes to age 75. Well, what happens is people have more income because they have to take it out. But what we've done with the conversions and the planning process in those earlier years of retirement, now we don't have as much to take out in those latter years, which minimizes those taxes, tax minimization. But it starts with planning. And if you don't plan, like many, you miss these years that we've had and going forward where unforced errors, missed opportunities. Well, nobody ever told me about that. Nobody ever told me about that. We hear that all the time. Again, it just starts with an educated discussion.
An educated discussion. That's what Larry is inviting you to have with the folks there at Haven Financial Group. It's understandable that you would know the answers to all of these sort of scenarios that we're posing, the tax questions, the best scenarios for converting to IRA. But the folks at Haven Financial Group, they do, and they would love to be your partner. 612-504-8400 is their number. me give that to you again. It's 612-504-8400. Give them a call. Tell them you heard us here. And you'd like to sit down and talk about your retirement, get some of these questions that we're posing answered for your respective situation. Coming up next, budget strategies to address inflation. That's right here on the Haven Financial Group Radio Show.